This is Taking Stock on Bloomberg. I'm Pim Fox. The weather, it's getting warmer. The summer travel season upon us. But while the S&P 500 is up for the year, airlines, they're underperforming. Delta, Continental, American, United, all down this year. So should you avoid the industry, or is now the time to head for bargains? To help answer these questions, we turn to Hunter Keay in Baltimore. He comes to us from Stifel, Nicolaus. Hunter, welcome.
Thanks, Pim.
Hunter, give us a little bit of an overview of what's going on in the airline business. They pulled capacity out of the domestic route structure. They did it a little bit in international. What's the state of the airline business?
Well, it still remains largely in flux. Pricing power continues to be absent from the industry, despite the fact that planes are relatively full. But unfortunately, the mix of travelers right now is still very, very skewed towards low-yielding, very elastic, highly discretionary type travelers. So I don't think we're going to get really much of pricing power traction in this industry until next year. But until that time, we're going to see continuing capacity discipline. We might even be just coming up on an additional round of capacity cut announcements by these guys, possibly as early as next week.
Now, Hunter, just to help us, educate us a little bit on something called RASM, right? This is revenue per available seat mile. What is it, and why is it important for an investor to know this if they want to go anywhere near an airline stock?
Well, you're exactly right. You shouldn't be investing in airline stocks if you don't know what RASM stands for. As you said, revenue per available seat mile. It's a similar metric to RevPAR in the lodging industry. It's really a measure of how much, and it's a dollar measure, how much revenue per dollar is an airline generating per seat it flies 1 mile. So right now, RASM trends are very, very negative. But a lot like other industries, we have seen some stabilization in the rate of year-over-year decline. Now, we're seeing RASM declines of 20% in May, is what a lot of carriers just reported. That's terrible, and it's among historic lows. But when you contrast that to sort of how it's been trending in recent months, we are seeing some signs of relative stabilization, but it remains very, very poor.
Now, Hunter, in a recent note, you talked about airlines actually buying load factors. What does that mean?
Yeah, buying load factor. And a load factor, to define that term, is essentially a measure of capacity utilization. It's how full the airplane is. So typically, load factors are very seasonal. In peak summer months, they can be as high as 90% for some carriers. And in off-peak months like February, sometimes you can see that drop into the 60s. Airlines like having high load factors because when the plane is full, it leads to pricing power, and obviously it generates cash flow. If you start discounting your tickets to very, very, very low levels, people will fly. You'll stimulate demand. That's what effectively what an airline is buying load. So if you sell your tickets below cost, you're effectively buying load factors. And airlines are doing that right to generate cash flow.
That generates cash flow, but it doesn't necessarily generate profits. Let's turn our attention now to what's going on at Delta Airlines, DAL. You just upgraded the shares this week. Why'd you do that?
I upgraded them, you're right. It's my only buy-rated stock right now in my universe. In my note, I used the term cautious optimism, long-term outlook. It was a call on where I see the stock going over the next 12 months, not necessarily the next 3 to 6 months. The temptation in the space is sometimes to focus solely on the short term because it's sometimes viewed as a trading group. But there have been times historically where a long-term position could very, very, very substantially outperform a broader market rally. I look at Delta and I see basically one of two scenarios unfolding over the next 12 months. I see either an economic improvement taking place, and in that the case, Delta wins because of the amount of capacity that's come out, or the economy stays very bad or gets worse, surprisingly, and a number one, maybe two of their larger competitors with less capitalization goes out of business, in which case Delta would benefit from a buy-the-survivor type scenario.
Now, you've got a price target of about $10 a share, right, on Delta, the stock trading for about $7 right now. Tell me the math that gets you to that 10. You've got a multiple, a 6.5 multiple?
Yeah, we used a multiple called enterprise value to EBITDAR, the R meaning rent, operating lease expense, essentially. So we adjust our enterprise value to capitalize some of the off-balance sheet debt, the operating leases, and we divide that by the forward-looking EBITDAR, what we expect them to earn. Historically, this multiple is typically around 8 to 9 times on a 12-month forward-looking basis. Right now, they're about 5 times. They were about a little under 5 when I upgraded them. Our target multiple is 6.5, so it's still a substantial discount to where these stocks have historically traded, but to obviously account for the ongoing risk and overall depressed general market multiples. But we think Delta should trade at a bit of a premium to the rest of the industry because of their strong liquidity position and revenue opportunities from the Northwest merger.
All right, we're going to
that's the valuation.
All right, we're going to continue the conversation with Hunter Keay from Stifel Nicolaus. We're going to dig deeper into some of the other airline stocks. You heard that Hunter saying that Delta was the only buy in his universe. We're going to ask him why he's not bullish on any of the other companies in the airline industry. This is Taking Stock on Bloomberg. I'm Pim Fox. My guest is Hunter Keay, analyst and expert in all things airline from Stifel Nicolaus. Hunter, talk a little bit about Continental Airlines and specifically compare, if you can, what's going on with the Trans-Pacific route structure and what's going on with the Transatlantic route structure.
Sure. First of all, Transatlantic, it's probably one of the hardest hit markets in the worldwide aviation industry right now. It's traditionally been one that's relied heavily on a lot of financial traffic. Corporate travel, as we spoke about before, has essentially vanished. The JFK to Heathrow route is basically dead. Newark carries a lot of passengers from Newark over to London. That's been extremely challenged with the meltdown of the financial sector. Pricing on that is arguably as bad there as it is anywhere worldwide. Continental expects their pricing on that market to decline roughly 25% in the second quarter. That's just terrible. But, of course, that's an issue not just specific to Continental. It applies to everyone. But what they're doing is they're taking a lot of that capacity and they're reallocating it to the Trans-Pacific routes. Of course, there's really no strength, and there's really no strong worldwide aviation markets right now. But Continental is taking this as an opportunity to move into some longer-term good growth strategy markets, for example, Newark to Shanghai. So the Pacific capacity is increasing at a double-digit clip right now, which, of course, hurts pricing when you're adding capacity. But longer term, we think it's a prudent strategy for them to play in the Chinese market.
All right, now they're playing in a market where oil is no longer $130 a barrel. That's the way it was last summer. What are jet fuel prices telling you?
Well, it's important when you analyze jet fuel prices that you not just look at the price of crude, but the refining margin to go from crude into jet fuel. And this is what's called the crack spread, the refining margin. Now, last year at this time, we had $130, $140 crude, but you had to tack on another $29, $30 to turn that crude into jet fuel. Right now, it only costs $3, and this is on a per barrel basis, $3. So when you look at $70 per crude, it's roughly $73. Divide that by 42, and that's your jet fuel cost per gallon. Substantial relief from the refining margins, and we expect that to continue. When you look forward at the jet fuel crack spread, the forward curve, it remains very, very tight, even by historical standards, and that's huge relief on the cost side for these guys. Can't be understated.
All right, Hunter, I'll give you about 20 seconds. You say that you're cautiously optimistic, although you've got a hold recommendation on Continental. Why is that?
Yeah, we do like Continental. We would probably wait for a little bit of an opportunistic pullback here. The valuation on 2010 looks a little bit rich at this point relative to some of their peers. Their RASM number, we talked about the unit revenue, that's been running at a little bit of a discount to the industry average. We think there's a decent chance the stock pulls back here. Relative value to the space, we'd wait for an opportunistic entry point. But in a longer term, buy the survivor type scenario, we think Delta and Continental, even under an extreme situation, will probably still be around into next year. So we feel comfortable in either one of those stocks longer term.
All right, and we always feel comfortable with your insight. I want to thank you very much, Hunter Keay, coming to us from Stifel Nicolaus, telling us about the airline industry.